So I recognize sometimes taxes just go way over people's heads. Trust me, I read the comments and I see sometimes some of these concepts are very complicated. So it really comes down to two main muscles that you need to flex. On one side, you got tax preparation, and on the other side, you got tax planning. And so tax planning is definitely gonna be that muscle that you're gonna wanna work out the most. And tax planning is simply a fancy term for analyzing your personal financial situation, your business financial situation, in order to maximize the tax code in the most efficient and legal manner. So tax rules can be complicated. And so in today's video, what I'm gonna do is I'm gonna give you guys 6 things that I think beginners need to know when it comes to understanding taxes. Let's go. What's going on, everybody? Brian Rivera, CPA, and I'm wanting to welcome you back to the channel. On this channel, I typically talk about personal finance, entrepreneurship, and investing. My mission is to help you slash that tax bill. So if you are new, don't forget to hit that subscribe button. So you can't plan for the future if you don't know where you are today. So the first step in your tax planning exercise is to identify what tax bracket are you in. So the US, Uncle Sam, we have a progressive tax system. So that means the higher your income is, the higher tax you're gonna pay. The lower your income is, the lower amount of taxes you're gonna pay. There are gonna be 7 federal tax brackets. It's gonna start at 10%, then it's gonna go to 12%, then it's gonna go to 22%, 24%, 32, 35, and then finally 37%. No matter what tax bracket you're in, you're probably not gonna pay that rate on your income. And there's 2 reasons why. Number 1 is gonna be you get to subtract deductions from your income to arrive at what's called taxable income. So that's why sometimes you may say, hey, well, I'm paying tax on less income that I actually made. It's because you get deductions. Now, the other reason why you don't just multiply your income by that particular tax rate is because the government allows you to divide your income into chunks or into subsets. And basically, if you have income that falls into that particular bracket, then you'll pay corresponding tax at that rate according to how much income is in that particular bracket. So let's take a look at an example. So let's just say you're a single filer and you make roughly $32,000 per year. Now, does that mean because you made $32,000, you're in the 12% tax bracket? Answer is no. You actually pay 10% on the first $10,275. Now, once your income exceeds $10,275, you're then gonna pay 12%, which all the rest of your income is gonna fall in the 12% tax rate. So the way the US tax system works is it's a graduated scale. So as your income levels up, so does your tax rate. But just because you have some income in a certain tax bracket, it doesn't necessarily mean that you're paying that particular rate. You actually have to divide your income into chunks. Tax tip number 2 is gonna be knowing the difference between tax deductions and tax credits. Now, both of these are awesome and they're great tax planning tools is because both of them are gonna help you reduce your taxable income, your tax obligation. However, they do it in different ways. Knowing the difference can create some very effective tax strategies to reduce your tax bill. So tax deductions, you can think of these as expenses that you've generated or that you've incurred that you can write off against your income. So this is gonna bring your total taxable income down. Now, tax credits are dope because they give you a dollar for dollar deduction against the tax you owe. So for example, if you have a tax credit that's valued at $2,000, this is gonna reduce the tax that you owe by $2,000. Now I've got a question for you. Would you rather have a $10,000 tax credit or a $10,000 tax write-off? I want you to pause this video and drop your answer in the comment section before I give my answer. So if you selected tax credit, congratulations, you are correct. Go ahead and give yourself a high five, dap yourself up, you're awesome. Now, if your AGI was $100,000 and you took the $10,000 tax deduction, your taxable income would be 90 grand, let's just say a tax rate of 25%. Total tax you owe, $22,500. Now let's just say you got a $10,000 tax credit. Well, the total tax you're gonna pay is $25,000. However, because you took a tax credit, which is a dollar for dollar deduction on your taxes, you now owe $15,000. Tax planning tip number 3 for beginners, understanding the itemized deduction versus the standard deduction. So generally speaking, based on your filing status, the IRS is gonna give you what's called the standard deduction. So I'll go ahead and post the table here so you can see based on your filing status. Now, this number changes each year, and it's basically an allocation that the government gives you, and they adjust it annually for inflation. So as inflation rises, so does your standard deduction. If your standard deduction is lower than your itemized deduction, then you're gonna take the greater of the two. You can't have both. So you're either gonna take the standard deduction or you're gonna take itemized. And so basically itemizing or itemized deductions, all it really means is you are taking individual deductions that are allowed on your tax return. And these are all gonna be reported on what's called a Schedule A. So the good news, tax software and a good CPA or a tax accountant is gonna help you figure out whether or not you're gonna use the standard or the itemized deductions. But some of the most common itemized deductions that you're gonna run across: medical costs, if you had significant medical expenses that you incurred during the year; charitable contributions, if you tithe to your church, or if you donate to nonprofit organizations, 501c3 type organizations. These are all gonna be charitable contributions. Some of the other things you wanna look for, and usually this is what's gonna help you get to the level of itemizing, is if you own your primary residence. So if you own your primary residence, typically you're gonna be able to not only write off the real estate tax, but you're also gonna be able to write off the interest on the loan if you have a loan on that particular property. Normally, when you accumulate all of those individual deductions, they will aggregate to more than your standard deduction. And in that scenario, you take the itemized deductions. Tax strategy tip number 4 for beginners is gonna be keep an eye on popular tax deductions and tax credits. So there's hundreds of tax credits and deductions that you can take. A lot of these have rules and regulations that you must abide by to make sure that you can qualify. So for some of the simpler ones, I'm gonna post a link below to where you can check that out and see if you qualify. And if you need more detailed guidance around these particular things, I'm currently running a free strategy webinar where we're gonna give you 3 strategies that are gonna help you slash $30,000 or more on your taxes. But for this to be applicable, you gotta be in one of the buckets of you're either a business owner or you're an investor to get the most bang for your buck. Tax tip for beginners number 5 is you gotta know which records to keep. So keeping your tax returns, keeping your supporting documentation, keeping your receipts for business deductions is gonna be crucial, especially if you're ever in a situation where your return is selected for audit. Usually the IRS has 3 years to audit you, and then also you usually have 3 years to file a claim for a refund if you did not file that particular tax return. So 3 years is a good benchmark for keeping some of those supporting documentation. Now, there are gonna be certain cases where you actually wanna keep these records even longer than that period that I just stated. So if you accidentally, or your CPA, your accountant underreported your income by at least 25%, you need to keep those records for now for 6 years. Now, if you wrote off losses for worthless securities, then you need to keep these records for 7 years. So a lot of the clients that my CPA firm services, they're investors, they're in the stock market, they're day trading, and sometimes you could be holding something that's considered worthless and it's not worth anything. So in that scenario, you're gonna be somebody that wants to keep this stuff for at least 7 years. Now, if you've committed tax fraud or you didn't file your return at all, then in this situation, you wanna keep your records indefinitely. My advice, do not commit tax fraud. All right, so number 6, the final tax strategy tip that I'm gonna give you for beginners is sheltering your income. So tax deductions, tax credits are great at lowering your tax bill, but what's even better is sheltering your income so that way Uncle Sam has no way to touch it. Now, I'm gonna say is, as an employee, as a W-2 employee, your hands are gonna be tied at what you can do. So what I'm gonna do is I'm gonna share with you some of the popular ones that employees are gonna be able to take. The first step is you wanna tweak your W-4. So what a W-4 form is, it's a form that documents your withholding. So your employer now knows how much money to withhold from your paycheck. When you have historically filed your tax return, if you're getting these massive refunds and you're only a W-2 employee, what that's gonna tell me is that tells me that you are paying too much in tax. Basically, you're giving the government an interest-free loan. So in that scenario is you wanna adjust your allowances per your W-4 down. You wanna get your income as close to zero in terms of receiving a refund as possible. Now, on the flip side, if you're paying too much money in tax, where you're always stroking a fat check and you don't like doing that, then you know that you have too many allowances, right? So the sweet spot is it's gonna be based on your filing status, how many dependents you have, but really your goal every year when you file your tax return is to break even. You wanna either pay zero but if you're in a scenario where you're a big earner, then obviously it's gonna be impossible. If you're somebody who has income that's very volatile or it fluctuates quarter over quarter, that's also very hard to predict. But if you're strictly a W-2 employee, your goal is to not pay Uncle Sam, and your goal is not to receive a fat refund. The other piece, max out your 401k. So if your employer offers a retirement plan, especially if they're gonna match you, then one of the best moves that you can make is contributing to that 401k plan. Now, obviously there's gonna be traditional and there's gonna be Roth components. But if it is a traditional, then all the money that you're putting into this plan is gonna be tax deferred, meaning you are not gonna pay any income tax on that particular money that's going in. And for this current tax year as an employee, the max that you can put into a retirement plan is $20,500. Now, if you are self-employed, obviously you have more options at what you can do. You can open up either a SEP IRA, a simple if you have employees, or you can actually go solo 401k if you're a single owned S Corp. And in that scenario, you can maximize even bigger deductions where you can do $61,000 per year. Now, outside of the employer sponsored plan, you also have the option to contribute to an IRA. There are some income thresholds as it relates to that, especially on the Roth side. So make sure that you follow the rules. I can't tell you how many times I've seen people try to contribute to a Roth plan, but their income doesn't allow it. So there are ways to get around it, but you can't contribute directly. You're gonna have to execute something like a backdoor. So another easy win is take a look into 529 plans. So these are good, especially if you have dependents and you are looking to get some tax write-offs and you're also looking to save for their future education. Some other easy wins, contributing to flexible spending accounts, health savings accounts, and even dependent care accounts. So now a lot of these particular accounts allow you to contribute tax-free dollars, meaning you're not gonna pay tax on qualified medical expense, taking your kids to daycare, all that good stuff. So these are good things to help you chip away at your tax bill. And these are just beginner strategies that I think every single beginner should know when it comes to taxes. All right, family, I know we covered a lot of information, but my goal here was to give you guys a baby step, some foundational knowledge, some basic concepts of things that I think every single beginner, somebody who's looking to learn more about taxes should know. This is foundational knowledge. This is not advanced tax strategy. This is not advanced tax write-offs. We are literally just taking a baby step. And I was just thinking about, okay, what are some things that every single person should know when it comes to understanding the tax code? So if you found value in today's video, don't forget to hit that like and subscribe, maybe even share it with a friend. And currently I'm running a free webinar that's gonna give you guys 3 strategies that's gonna help you save $30,000 or more per year in your taxes. And I'm gonna drop a link below. Have a good one.